This is level 3 of the CFA program, the topic on asset allocation, and the reading on asset allocation with real-world constraints. One very interesting sentence that appears in the beginning of this reading sounds something like this. Modern portfolio theory was developed in a world absent of transaction costs. Recall that those founding fathers of finance assumed a world in which there was a rational investor. There were no such things as taxes. There were no such things as bid-ask spreads. And there were a whole host of assumptions that made this, kind of like a restrictive world. But that restrictive world gave us tremendous laser insight into the value of investment research. And then what we've done over the years is we've relaxed all those assumptions so that we can make some real world decisions based on that theory. Now, you'll see that when we go through these learning outcome statements, we'll talk about some constraints in the first one. Then we'll talk about taxes and short-term shifts. And then notice that last LOS, we'll go ahead and revisit some of the behavioral biases that we talked about in those handful of readings at the beginning of level 3. And I might comment that it's probably interesting to compare the behavioral biases discussed in this reading with all of the ones discussed back in those first couple of readings and see which ones are repeated. And those are probably ones that you should know for the exam. So let's go ahead and start with just a brief recap and recall that the policy statement has a handful of constraints. What we're talking about specifically here are the constraints as they affect the asset allocation decision. So in the next couple of slides, we'll talk about size, horizon, liquidity, and some external constraints. But one of those assumptions that the founding fathers of finance made was that investors had pretty sufficient and equal ability to access the entire investment opportunity set. I mean, it makes perfect sense that if I'm an investor and I own 100 shares of Johnson & Johnson stock, that I can just show up on the floor of the New York Stock Exchange and I can sell those, right, immediately. So lots of liquidity there. But on the other hand, suppose that I own a year 1900 bottle of whiskey that might be valued at $10,000 or $20,000, and I want to access that because I have some liquidity need of my own. Well, the old-time whiskey market, I don't know what it's called. How about that? Old-time whiskey market. It's probably not as liquid as the floor of the New York Stock Exchange. So what we're going to have to do is overcome this unequal ability to access the highly liquid share of Johnson & Johnson versus some alternative investment. So let's go ahead and get started with asset size. And let me go ahead and skip ahead one slide. So notice here we have smaller funds, and then we have larger funds, and then very large funds. So asset size has an additional restriction or a constraint because there are problems with funds that are too small and problems with funds that are too large. So think about a relatively small portfolio, and I'll give you just an extreme example. Suppose I'm your client and I show up at your office with a $100 bill, and I say, I would like to invest in the S&P 500 index. And you say, all right, let me do the math quickly. There's $100, there's 500 stocks. How do I divide that? I'm going to have to buy fractions of shares of stock. And so this is going to be too big of a restriction. And so what's probably going to happen is the issue of diversification is going to play a role in these smaller funds. So that's why we have that in that first orange bullet point. There could be local restrictions imposed by capital markets. You could say to me, hey, Jim, you don't really need me. Why don't you just take your $100 and go buy a passive 500 index fund? But as well as I do, that these fund families, they probably won't let me get in for just $100. Now, some of them might. I think the major ones require, let's say, $2,000 or $3,000 of a minimum investment amount, or you could probably agree to give them access to your checking account and make regular withdrawals. So remember local restrictions. And then if I only have $100, I'm probably not going to be able to pay for top level management and any kind of expertise. So look at that bottom bullet point. Limits the number of possible asset classes. All right, that makes sense. So let's get bigger. Let's go to larger funds. And this probably takes care of the diversification problem, mostly because of the size of the portfolio. But what this will allow us to do is to achieve economies of scale. And we might even have some negotiating power for management fees. And we'll probably be able to pursue complex strategies that include, almost anything that we're learning in this CFA program. But the one I like, based on my example just a few moments ago, is this: we'll be able to allocate more capital to alternative investments. So maybe I can't buy just one bottle of year 1900 whiskey, but I could buy 1920 and 1880 and all different kinds, so I can diversify across the old-time whiskey bottle market. All right, so larger funds, they take care of those problems with diversification, but let's suppose that we have a super large fund. So let me give you another extreme example. Suppose that I show up at your office and I have $1 trillion. That's, of course, an extreme example. And I say something like, let's decide on a strategic asset allocation of 20% of the S&P 500. And so you say, okay, so 20% of $1 trillion, let's go ahead and do it. How am I possibly going to buy all of those, especially if I show up on the floor of the New York Stock Exchange to buy all of those funds? That's going to influence, pricing and bid-ask spreads and all that stuff. If I go the way of a fund manager, then maybe that fund manager can't absorb that huge amount of funds. If I go to private equity or to hedge funds, maybe I have to buy up an entire hedge fund, and that's probably not what I want to do. So I think my two extreme examples, the $100 bill example and the $1 trillion portfolio, this illustrates the problems at the extreme ends. Now, moving on to liquidity, recall that liquidity has two kinds of issues. Remember, there's a liquidity constraint inside of the policy statement. And recall that liquidity constraint typically means an expected one-time lump sum cash outflow for the client. For example, maybe a client wants to buy a Harley-Davidson motorcycle in 6 months for $50,000. So what we would probably do is just take $50,000 aside today, put it into some 6-month certificate of deposit or something, so that we'd have that money in 6 months. What this reading is focused on here is the left-hand side of the balance sheet for, these 4 institutional investors and then individuals. How liquid are the assets inside of the portfolio? Let's go back to my example. How liquid is that share of Johnson & Johnson stock? What did I do? Snap my fingers. That's super liquid. How liquid is my year 1900 bottle of whiskey? Probably not liquid at all. So you might remember that I regularly tell you guys to get out your phones and take a picture. I think this is a good one here. So take a picture of this slide. This is a summary of a handful of pages in the reading. And the focus, of course, is on the liquidity of the assets inside of the portfolio. So we could probably do this relatively quickly. So what do we know about banks? Banks, they raise capital by accepting deposits. So they have people like me showing up every day, depositing our capital, and we could change our mind in 10 minutes or 10 hours or 10 days. And so the banks probably have to invest in extremely highly liquid securities. Notice the bottom left-hand box. They must carry on their day-to-day operations. They have to be able to make their cash outflows on a daily basis, and they have to repay people like me who show up and say, hey, I need $500 today because I want to go over there and I need cash for that, whatever that is. Property and casualty insurance companies, these insurance companies, they have super high liquidity needs, mostly because their claims are unpredictable. So if I go to the insurance company and I say, here's my house, and I want to insure it against things like, fires and Flood, that's an entirely different story, right? And lightning bolts and a bear crashing into my back patio. The insurance company is going to charge me a premium, but those claims are relatively unpredictable, right? If you ask an actuary, what is the probability that a bear is going to crash down in Jim's backyard through his Leland cypress trees and, into his kitchen? I don't even know what that probability is. I mean, some actuary would be able to give you some idea of it. So the claims are unpredictable. So what kind of securities are these insurance companies likely to invest in? Lots and lots of liquidity. Sovereign wealth funds and endowments, particularly the reading talks about university endowments, they have super low liquidity needs. Although some college endowments funds will have a policy where they'll take 2 or 4 or maybe 5% of their total assets, sell those during the course of the year to help fund their university expenses. Nevertheless, it's still low liquidity needs. If those liquidity issues are 3 or 5% or whatever I said, well, then they can have a portion of the portfolio invested in Johnson & Johnson stocks so they can sell it pretty easily. Remember that these are long-term horizons, super, super long-term. I always get lots of really good stuff out of the readings, and I always encourage the candidates to go ahead and take a look at the readings. I found out something that I never knew before, but I'm going to use it in my classes and I'm going to share it with you. It's just one sentence, one little nugget of probably useless information, but it'll help me in class. Maybe it'll help you on the exam. The Norwegian Sovereign Wealth Fund only allows a 7% allocation to alternative investments, and it restricts those alternative investments to real estate. So the Norwegian Sovereign Wealth Fund cannot invest in the 1900 bottle of whiskey. Now, life insurance companies and auto insurance companies, these actuaries, these people have a much higher ability to predict. Like my friends in the actuary business, they'll look at me and they say, you know what, Jim, I know exactly when you're going to die. You're 61 years old today, you're going to die when you're 77. And of course, they don't mean me specifically, but they mean if they have a sample of, let's say, 1,000 61-year-old college professors, on average, we'll die when we're 77 years. So what they'll probably do is they'll go out and find some bonds that have durations of 17 years. And so what does that mean? That they probably have way less liquidity needs, right? They're not going to need that capital for 17 years. They don't know which of us, of that 1,000 college professors, are going to die in 17 years, but they know how many of us out of that pool will die. All right, how about the far right column? Individuals. This is interesting. Individuals depends on the circumstance of the individual. Of course, that's true. Some individuals have lots of liquidity because, well, they like to have lots of liquidity, but some individuals have lots of liquidity because they have very, very low tolerance for risk. And so they want to say something like, you know what, I want to have access to my money. My father was like this during the later years of his life. Moving on to the time horizon constraint, and this has to be determined by a timeline. So I always tell my students when they get to a problem on the exam for a time constraint is just to draw a timeline, and on that timeline are going to be liabilities, or at least expected cash flows or liabilities at some point on that timeline. And then, of course, you just sometimes take the present value, or sometimes you buy a bond that matures. Buy a bond that has a duration of that specific date. Another part of this reading here is that, remember, we talked about those extended assets and liabilities. One of those was human capital. Another was, like present value of inheritance and present value of expected liabilities. And so those characteristics, they probably change over time. In fact, human capital declines with time. That's pretty much a standard a standard idea. You might remember in one of those earlier recordings, I made the comment that I felt like I'm a way better professor now than I was 20 years ago. But I guess the Institute thinks that my human capital is declining. And of course it probably is, if only because I don't have that much longer to teach. So one of the things that a good financial analyst will worry about is the term structure. So you have all these liabilities on a timeline. So you do the timeline, that's the horizontal axis, and then you can plot yields on the vertical axis. So you get a sense of that term structure, which means then that term structure of the liabilities gives you an indication of what term structure to look like over on the left-hand side of the balance sheet. Now, of course, this doesn't apply just only to individuals. It applies to some types of institutions, and the reading emphasizes a pension fund. So look down the left-hand column of that box. So if the workforce is comprised of younger or middle-aged or those who have impending retirement, then we're going to decide which types of bonds that we're going to invest in. So longer term bonds, right, for the younger workforce, intermediate term bonds, and then all bonds, or maybe some cash for impending retirement. Now, of course, inside of this time horizon constraint is a link back to the risk and return objective. Recall in the policy statement, we're going to come up with probably a mathematical return objective, like 10%. And then for the risk objective, we might come up with a mathematical standard deviation, let's say acceptable standard deviation of 20%, or we might just grade these into low or moderate or high risk. But whatever that is, what we need to do is we need to match, of course, the left-hand side and the right-hand side of the balance sheet. And this is really just the issue that the reading calls time diversification, which probably implies that longer horizon goals can tolerate higher volatility. And my students, they regularly ask me about my personal investments. And they point out to me, they say, Jim, you're not the spring chicken you were a long time ago. Are you lowering your volatility? And I always respond that, being 61 years old, I don't feel like I'm ready for low volatility portfolios, but some clients are, and probably on average, those in their 60s probably are. Investors' goals or liabilities. Remember in one of those previous recordings, we talked about ranking those priorities. We talked about ranking the goals and having sub-goals and portfolios that match those sub-goals. We'll talk a little bit more at length about that later on in this slide deck. But of course, these goals change over time. And I want to point something out to you in the reading. I say this regularly. There's so many cool things in these readings. And this particular reading was super valuable for me. But there's an example of a married client. They're both in their mid-50s. They're both pretty successful. But they have different goals. One of the goals was to fund their future lifestyle. One goal was to pay for one of their dependents' college education. One goal was they had a granddaughter that had some special needs, so they wanted to put together a trust. And then I think the other goal may have been related to retirement. And so they put together this portfolio that matches, those goals and sub-goals. And then in the next paragraph, the reading says, let's skip until this couple is in their mid-70s. So 20 years later, well, they've funded the trust fund for the special needs granddaughter. So that was already achieved. The son had already graduated from college and had a good job. And so that was gone. And so they had some different kinds of goals. And so that's an illustration of, hey, 55 is one set of goals, 75 is another set of goals. It was interesting. I think in this particular example, they said they wanted to fund their their lifestyle until they were 95. So they kind of picked a death date. And I always have fun with my students. They say, well, how do you decide when a client is going to die? And I say, well, you know what? Call up an insurance person and ask them what they think about it. How about regulatory and other external constraints here? So local laws, regulations, and maybe some others. Here's the example that I give my students all the time. And I think that this might have been an example that I learned back when I went through the CFA program, back in 2003 or whenever that was. That there was a client, and this was probably in one of the readings, who was an executive for a big company. And as part of the employment contract of this executive, there was a sentence in there that said something like, as terms of your employment are that you can't hold any stock in these competing firms. And so that makes perfect sense. But clearly that has a restraint, that has a constraint, a restriction on, let's go ahead and diversify our portfolio. Now let's go ahead and go through some of these regulatory and other external constraints for some institutions here. So insurance companies, what did we say earlier? They're going to immunize. There's that word that I was talking about, matching the investment horizon with the duration of the bond. Yeah, high concentration of fixed income securities. So that makes perfect sense. Some other restrictions are that some countries and localities restrict the amount of equity securities that insurance companies can invest in. That's why a lot of insurance companies, they have this huge fixed income portfolio and then a small equity portfolio. Maybe that's kind of a surplus, kind of a management. We talked about that in a previous reading. So what do we need to do here? We need to focus on meeting those future liabilities, so paying the claims and also maintaining the financial strength of a company. Chief financial officers regularly say things like, well, look, we need to do stuff today that's going to enable us to be able to do stuff in 10 years. And so maintaining financial strength of the company. Other risk considerations, risk-based capital measures. Of course, we want to make certain that when we decide on this allocation that we have specific metrics in mind that are reflective of their risk levels. And then, of course, yield levels and credit ratings. There's liquidation. We talk about that. Financial health of the insurance company. How about pension funds? That first line there, this is all you need to know about pension funds and this particular constraint. Most regulated of all of the institutional investors. And at least from a global sense, right, a big picture sense, this probably is highly intuitive because, the firm has a contractual obligation to pay its employees when they retire. So we have all these different sorts of constraints, tax reporting, accounting, funding, et cetera, et cetera. Endowments and foundations, these are the least constrained. We talked about this just before. Infinite time horizon. I think I might have used the term super long time horizon. I guess that means infinite. All possible asset class, equity, and alternative investments. Sovereign wealth funds. This is what I was saying earlier about the Norwegian fund. And as a sports fan, I can't help but go ahead and mention this. Those of you who are golf fans, you'll know that there's this Live Golf Tour that has poached some of the great golfers from the PGA Tour, and it's been very, very controversial. However, the underlying asset here is this sovereign wealth fund. Invest on behalf of the citizens of a particular country. And so clearly this sovereign wealth fund has decided that creating a new professional golf circuit is going to benefit the citizens of that particular country. So they're really not legally obligated to match liabilities and assets. And so the constraints are typically from the voters. All right, how about an LOS on tax considerations here? So I'm guessing that you know this from level 1 and level 2. What do we have? We have interest income on bonds. We have dividend income on equity securities. We have capital gains and losses on stocks and bonds, but we also have capital gains and losses on alternative investments, right? So let's not forget, what did I say earlier? My year 1900 bottle of whiskey, maybe I paid $20,000 for that thing, and maybe today I could sell it for $12,000 or $8,000, right? So don't forget that these capital losses can occur in all different areas of these asset classes. So how do we tax these things? So typically interest income is taxed at higher income tax rates relative to capital gains. In some countries, dividend income is taxed at a lower rate, but there might be some other rate in there. And so clearly, the Institute is not requiring us to become tax experts. Look at that diamond point, the blue one there. Does not require candidates to learn the tax codes of any jurisdiction. So I say this kind of regularly, that the Institute, they don't require us to be tax experts or legal experts or estate planning experts, but they require us to know enough so that we can find out the answers that are relevant for our particular client. So we've got these different tax rates spread across all these different asset classes. So we need to know all the tax rules. We need to know about the tax-deferred, tax-exempt, taxable accounts, and how they apply to different entities. So here's my analogy that I give all the time. The Institute, they want us to know breadth, right? So we need to know these things. Now the depth, we're not required to be experts, but we need to know when we hit this part of the breadth and we need to go deeper, that we just ask an expert. And there's no shame in asking someone, hey, can you help me out here? And that's what our colleagues are for. So look down on the bottom right. What we need to do is make certain that when we're forming our strategic asset allocation, that we're doing this in a tax-efficient environment. So here's a super simple equation. Let's go ahead and try to estimate our expected after-tax return, which is our pre-tax return, expected pre-tax return times 1 minus the expected tax rate. And of course, I'm always fascinated by expected tax rate. Here in the United States, we have politicians on this side saying one thing, politicians on this side saying another thing. So whoever wins the election is going to be reflective of what that expected tax rate is. So here, the Institute they don't want us to become political scientists, but they do want us to be aware about the politics and the influence on what that expected tax rate is going to be. So essentially what the average scenario would be is to take, 50% chance that these people win, 50% chance that these people win. They say this tax rate, they say this tax rate, so just meet in the middle somewhere. That's the expected tax rate. But I wouldn't think that would be an exam question. And remember that these LOSs are just discussed. They don't ask us to compute or to calculate, even though we're going to work through a mathematical example here in just a little bit. So how about an expected after-tax return on equities? Well, this is just going to be a weighted average. So look, there's 1 minus the tax on dividends, and then over on the right-hand side, there's 1 minus the tax on the capital gains. So we're just assuming that these are two different numbers, right? And then the P's are the proportion, and then the R's are just the expected returns. So this expected after-tax return on equities, think of this as total after-tax return on equities, is just a weighted average. So let's do a quick example. Even though the LOS doesn't ask us to, what did I say earlier? Calculate, compute, or demonstrate. So there are some relevant variables in the question stem. And so you can pause the video and go ahead and work through the math down at the bottom. But you can see that it's really just a weighted average. And if the tax rate is higher, right, that eats into 20% tax on dividend income, that eats more into the returns in the equity market than over in the capital gains, right, the dividend versus capital gains. Yeah, this is a super interesting slide. This has tremendous political implications for the future. This has nothing to do with the LOS right now, but I'm sure you know that some politicians are floating the idea that we ought to tax unrealized capital gains. But what you need to know for the LOS is that sometimes there's a tax liability created, sometimes there's a tax asset created, and of course it depends on the relationship between market value and the cost basis of the asset. Now, how do we adjust the market value to consider what that supposed or that expected tax asset or tax liability might be today? So if we go back to this previous slide, almost never will the cost basis of the asset equal the market value of the asset. So we need to ask ourselves the question, hey, let's plan, right? The Institute says, all right, we have this idea today. Let's go ahead and plan for the future. So we say, let's go ahead and assume that the asset is sold today. Then we can figure out, that's what's in that top red box. And then we can say, let's suppose that the asset is sold sometime in the future. Well, what we can do is we can do present values, and we can use a discount rate of the asset's after-tax return, or we can do it at the risk-free rate, depending on what that particular asset is. And then, of course, as good financial analysts, we can go ahead and say something like, oh, we don't want to only make a tax efficient decision based on the first moment of the distribution, right? The expected return. How about the expected standard deviation of that tax, that after-tax return? So there's a simple equation up there. Discuss those taxes. So taxes reduce the expected mean, and they lower the dispersion or the standard deviation of returns. So we should probably consider that not only in our tax efficient planning, but also down at the bottom under portfolio rebalancing. So what are we going to do under rebalancing? We want to minimize our tax, but we also want to maintain our strategic asset allocation. So how about an after-tax rebalancing range? Well, this is just an equation that we've had a long, long time, right? We're going to take that pre-tax rebalancing range and divide it by 1 minus the tax rate. We divide by 1 minus the tax rate in a host of level 1 and level 2 examples. What are we going to do? We're probably going to say something like, hey, you know what, Jim? That 1900 bottle of whiskey that you bought for, what did I say, 20,000, and now you can sell it for 8,000. You have a bunch of capital gains over here for your, what did I say earlier, Johnson & Johnson stock and maybe some other things. Why don't we go ahead and sell that thing, 20,000 down to 8,000? So there's a $12,000 loss. Now, of course, we're limited in whatever the tax rules are to offset capital losses with offset capital gains with those capital losses. So how about strategic tax location? So we're going to place less tax efficient assets somewhere in accounts that offer a favorable tax treatment. We're going to put tax efficient assets into taxable accounts. And then we're going to find out, hey, you know what? Where are we going in the future? Low tax rate, deferred capital gains, et cetera, et cetera. So tax-exempt accounts, they require no tax adjustments. Tax-deferred accounts, those assets are going to grow tax-free. But then, of course, upon, like a tax-deferred retirement account, we're going to have to pay an income tax upon distribution. All right, what are some general rules of placing assets into tax? All right, so if we put equities in these accounts, we're probably going to have, maybe some high turnover. We're probably going to put bonds in taxable accounts based on their liquidity. So here's a great question that occurs, all throughout the program in terms of monitoring and rebalancing. When do you do this? And the Institute pretty much has lasered in on, of course, you've got to do this at least annually, because during the course of the year, there are going to be tons and tons of things that happen outside of the policy statement, let alone stuff that might be happening inside of the policy statement. So at least, of course, an annual basis. But following any major events, and then significant changes in investor circumstances. So change in goals, change in constraints, change in beliefs. What are those changes? Getting married, change in occupation, leaving the employment, having children. I will also put one in there that the reading doesn't mention, but I know the Institute has had several kinds of paragraphs inside of readings over the years about dependent parents. This is a big issue today because our parents are living longer and longer, and then, maybe they move out of their homes, maybe they move into an assisted living place, and so children are finding themselves having to take care of their parents in their old age, in their aging years, which of course makes perfect sense. I regularly tell my students at the end of class, I say, look, take out your phone. I say, somebody changed your diaper when you were 2 years old. Text them right now and tell them that you love them. And so that, that kind of goes along with, all right, when the parents get older, we need to probably worry about taking care of them. Institutions. Let me go back to my college and university endowment fund. What did I say earlier? Some institutions, they like to use 5% of the endowment fund to help fund operations, but that 5% could change over time for varieties of reasons. Suppose that an institution all of a sudden got a $1 trillion donation. That would probably change things. Boy, do you want to do 5% of $1 trillion, or do you want to do 5% of $1 billion? That makes perfect sense. But clearly, economic conditions will impact philanthropy and the willingness of donors to provide capital on regular basis is there. So business cycle and pension obligation. All right, so portfolio constraints, right? So limits the amount of risk that can be assumed in the portfolio. So these are the regular old liquidity constraint, the investment horizon constraint, the tax constraint, the legal and regulatory constraints, and then the Institute calls that fifth category unique circumstance constraints, which you might remember from my earlier recording. I say things like, hey, let's put all of the behavioral issues into that constraint. So what we're doing here in this section, in our asset allocation portion here, is to say something like, look, if changes in those constraints occur, then that might call for a revision of the portfolio asset allocation. So there are a couple of examples there that are inside of the institutions or the individual's description of their lifestyle, or the description of the institution's board of directors, or changes in attitudes. And then, of course, we can have some extemporaneous influences there, changes in the economic environment. Just think of something like COVID. Did COVID change the constraints of a pension fund or of an endowment fund? And the answer is, probably yes. All right, so this slide is going to distinguish between the broad overall strategic asset allocation model, which are the long-term proportions or weights that we assign to the investor's policy statement. And so let's just say something like this, that we have 60% equity, 40% fixed income securities. So those are the strategic asset allocation broad stroke weights. But then inside of that 60% and 40%, we can have all of these subcategories in there. But then what happens? Over time, some things change. Cyclical variations, temporary price dislocations. So what did I tell you guys before? That these fathers of modern portfolio theory, they believed in the efficient markets hypothesis, that stock prices reflected all relevant and publicly available information. But I also gave you examples of where there are pockets of inefficiency and pockets of undervalued and overvalued securities. And so, boy, what do we do? Well, this is the tactical asset allocation. These are short-term deviations due to, well, those two teardrop points, but, a host of other kinds of examples that show up. Let's go back to my year 1900 bottle of whiskey. What did I say? I paid $20,000 for that thing. Well, suppose that something happens over here. Suppose there's a wealthy investor out here who was secretly keeping and maintaining an inventory in his or her wine cellar of, let's say 1,000 bottles of year, 1890, 1900, and 1910 bottle of whiskey. And all of a sudden, he dies or she dies, his children inherit this and they say, we don't want this stuff, we want to sell it. So there's a massive dump, a massive increase in the supply of 1900 bottles of whiskey. What does that do? What does that do to my investment, my asset allocation to my one bottle? So temporary price dislocations, that might sound like a permanent change in the supply. So clearly we need to address tactically what to do, and that might have implications strategically. All right, so here's a summary table of what I was just saying here. Features of strategic asset allocation. So we're trying to increase risk-adjusted returns. So what are we doing with this strategic asset allocation? Do you remember in that previous recording, I gave you the idea of let's pretend that we're the 5 offensive linemen on a football team, and what are we trying to do? Push the defense back. And in the efficient frontier framework, we're trying to push up into that northwest corner. What we're assuming is that short-term investment returns are probably pretty predictable, right? And so what we're going to do is we're going to deviate there for probably no more than a year. But what we can do is we can use Sharpe to evaluate the strategic asset allocation and the tactical asset allocation. We can use information ratio, we can use T-stats, we can use all of the quantitative methods that we learned before. And notice in the middle there, right? Comparing portfolios that lie on the efficient frontier. So we're trying to push up, and then we're going to look around and say, okay, what are the other offensive linemen doing? What are the other funds doing? What are the other wealth managers doing? How effective are we in pushing against that efficient frontier? And this is where, that's one of my favorite readings in all of the program, this attribution analysis. I love taking my students through the process of figuring out, all right, was it the allocation decision that gave us superior or inferior performance, or was it our asset selection decisions that gave us our inferior or our superior performance? Now, of course, the temptation is to tactically make these decisions all the time, right? Tactical asset allocation doesn't mean that we're going to have high turnover, doesn't mean we're going to pay lots and lots of taxes, doesn't mean that we're going to end up with less diversified portfolios, but it might. And so these are the drawbacks here. So higher trading costs, maybe some extra tax liabilities, and then maybe we can underweight or overweight. So all of a sudden, we have 27% of our portfolio invested in either long or short positions, depending on what our fund allows in, let's just say the healthcare industry. And that probably deviates too much from that strategic asset allocation. So let me go ahead and remind you of this. A good policy statement is going to allow for ranges for those strategic allocation weights so that tactically you can go inside of that corridor or that bandwidth without violating the strategic long-term goals of risk and return. All right, we can do this one of two ways here. So watch this. So here's the discretionary, and then here's the systematic, right? So let's go ahead and do a discretionary approach. This involves the judgment and the analysis of the manager. And so what is the portfolio manager or the wealth advisor doing? What are we doing? We are monitoring the macroeconomic environment. We are monitoring the microeconomic environment, and then we're monitoring our specific clients' needs. So we're trying to match those risk and return objectives inside of this range based on things like, well, what do we have written in that second diamond point? GDP, inflation, risk premiums, energy prices, right? Local wars throughout the country, throughout countries of the world. unemployment rates, et cetera, et cetera. And remember, we just had a reading where we talked about correlations between and among all of these macroeconomic factors. Remember, we even talked about the Fama and French factor model. So we're doing all that stuff, and we're trying to find short-term mispricing securities or asset classes. So there's that third diamond point. This is just an example here. If we think inflation is going to fall, what that means is that we expect interest rates to fall. So we're hoping that we have not only lots of fixed income securities as our allocation, but we're probably going to transfer. We're going to shift our allocation. This would be a tactical shift. And boy, we might want to tactically shift to bonds that have longer durations. All right, that fourth diamond point there's the ranges or the limits that I was talking about before. And there's an example, weightings up to 15%. And then, of course, do we want to get into some kind of a behavioral conversation here? We'll do that in just a few slides. Market sentiment, which might lead to momentum, might mean to some additional reliance on technical analysis. So optimism or pessimism. All right, so what are we going to do if we tactically shift our allocations? Maybe we'll do some margins. Maybe we'll do some shorting. Maybe we'll go all the way over to the volatility index. Instead of saying something like, you know what, I want to invest in higher equity securities, and I want to do this in a margin account. Maybe I want to short some of these. We could just go over to a volatility index and say, you know what, we'll benefit, if we have lots and lots of volatility. So a couple of different ways to do this. Now, what we can also do is we can go ahead and do our fundamental analysis to find undervalued stocks and overvalued stocks, and we can take long or short positions. This is called the systematic approach. Or we can ignore fundamentals and just go ahead and perform some technical analysis for momentum or growth or some other kind of behavioral issue that is, and here, remember, this is important, that is persistent and expected to be sustainable. Remember when we talked about taking advantage of behavioral issues, it's one thing to say something like, there are a bunch of traders out there who are experiencing the problems with loss aversion. We'll talk about that in just a few minutes. It's one thing to say and observe that there are loss averse investors out there, but it's another thing to come up with a strategy that's going to persist for, let's say 6 months or 12 months, growth or momentum. We don't want to pursue a strategy for our client that's going to last for 3 days. That doesn't sound like something that would be valuable. All right, so let's go ahead and continue our discussion from the very first 2 readings in level 3, these behavioral biases. So just a reminder here, there are mistakes that we make in the brain. We call those cognitive errors. There are mistakes that we make of the heart. Those are called emotional biases. And while they're not totally independent, the correlation coefficient between mistakes up here and mistakes here, it's not zero. Problems of the heart lead us to problems of the brain. And this is just because of regular old general human nature. All right, loss aversion. This tells us that investors have an irrational dislike of losses in a portfolio. In other words, they view gains differently than they view losses. It's not a symmetric process. You might remember I probably gave you the Tom Brady example where he said something like, every Super Bowl win, it doesn't make up for my Super Bowl losses. So that's loss aversion. So remember, one of the things that we did back in those behavioral readings is we said something like, if we have an individual who is averse to losses, what we can do is we can say something like, let's go ahead and rank your goals. Goal number 1, goal number 2, goal number 3, goal number 4, and let's have sub-portfolios that achieve each of those goals, which will minimize the potential for loss. Like for example, a client may say something like, I have a 5-year-old and I want to send my child to a top level school, and that is going to cost me $400,000. Let's just pick a number. And that $400,000 is a series of future cash outflows. Well, let's go ahead and take the present value of those future cash outflow tuition payments, and let's invest that in a well-diversified portfolio of low-risk assets so that after, what did I say, 5 years old? So in 13 years, when that child turns 18, that client is pretty much, I don't want to say guaranteed, but pretty much guaranteed, I'll use that word anyway, to have that, what did I say, 400,000 or 300,000, whatever that amount is, goals-based investing. So what does that do? Prevents abandoning of a strategic asset allocation in market downturns. The last thing we want to do is put that present value into an equity portfolio, and the equity portfolio expands and it contracts a little and expands. And then 3 months before that child goes to college, we have COVID and we have a nuclear war and we have other things, and the stock market crashes, and we have to say to the client, "Oh, we're so sorry. Can you believe we don't have any money for your child to go to college?" So that's the last thing that we want. Illusion of control. This is particularly relevant for clients who work for a particular large company that has equity traded on one of the exchanges out there. So believing that the performance is able to influence events, this probably lends itself to extra turnover, maybe trading too frequently, failure to diversify, and then, of course, linking this back to what we were saying earlier, there's no possible way that if an investor illustrates the illusion of control bias, that it is a tax-efficient portfolio. Mental accounting. My mother was very, very guilty of mental accounting. When she was alive, she had an account for this, she had an account for this, and it didn't have anything to do with anything else with her entire portfolio. Of course, my parents were very modest, so they didn't have a big portfolio, but my mother was a planner and taught us a lot about organization and the value of planning. My father was probably just the opposite. So once again, goals-based investing can handle this particular bias. How about this? We're always tempted to place lots of weight on the most recent event. This occurs in the sports world all the time. If you watch football or basketball games or golf or hockey, and a team has a tremendous performance, they say something like, "Oh my gosh, this team is destined for the Super Bowl or the World Series. Look at how great they played in this game or these last 3 games. All these players are doing great things. They're on this trajectory to be champions." Well, this is called the representative bias, that we're going to place way more importance on that because what we're assuming in going from one or a handful of games to a Super Bowl or a World Series is that none of these players are going to get injured. So how do you deal with this representative bias? Well, you've got to have a strong governance framework, which means you have to have a strong and a disciplined policy statement, which says something like, all right, here's our strategic allocation. Here is the range of the acceptable corridor, and we're going to be disciplined, right? We're not going to go outside of this based on whether or not Tom Brady gets a divorce and can take Tampa Bay to a Super Bowl. Framing bias, it's super interesting, the example that the reading gives, and I'm guessing that you guys experience this all the time. I know I do in meetings. Let's suppose you have a committee and you have a very strong-willed chair of that committee. And so the chair gets to set the agenda. And so during the meeting, the chair comes in and says something like, all right, this is what we're going to do. Here are our priorities. This is how we're going to think. Does anybody have any ideas? And if this has been going on for some time, the individuals on the committee, they start thinking, oh, you know what? That sounds like a really good idea. I'm in favor of all of this, right? So framing bias, how a decision is framed is probably going to impact the ultimate decision. And so what we need to do to avoid the consequences of this framing bias is to, I'm just going to go back here, to have a strong governance framework as well, but also to make certain that we have this full range of information when communicating with clients. And this can be as simple as just playing devil's advocate. So if you have a client who says something like this, whatever this is, it's our job as good financial analysts to say, you know what, I agree with all this. I think that's a great idea, but what happens in the event of inflation? What happens in the event of an energy crisis? What happens? So playing devil's advocate. There's a famous college football coach who spends his last 48 hours before every game going over contingency planning. And that's pretty much what we're having and what I'm suggesting here. This football coach says something like, all right, what if we get to the stadium and the lights go out and we have to go back into the locker room? What happens if we get to the stadium and it's a total sellout and the fans are screaming their guts out and we can't hear the quarterback calling out the signals? What happens if we have an injury? What happens if there's no water on the sideline? What happens? So this is a plan. What does that say there? Full range of information. Availability bias, you guys are guilty of this just like I am. What do you do when you wake up in the morning? I mean, I don't do this because I really don't like my phone, but I know everybody in my family, they turn their phone on and they go to their favorite web page. Now, if I were to do this every morning, I would go to the Wall Street Journal and I would read about, whatever interests me. So the ease with which information is obtained. And so what are we attracted to? We're attracted to information that's probably going to confirm our previous ideas. So here we have a combination of the availability bias and the confirmation bias. And so we have to be concerned about putting too much weight. Didn't we just talk about this? Too much weight on available information and recent information. Do you see what I was saying earlier? That all of these biases, they do not have correlation coefficients of 0. Now remember, in just a recent reading, we talked about the importance of this global market portfolio, and that's probably a really good way to help lessen this availability bias. So what's a summary here? Good investment government. So we want strong, most useful responses to these biases. Solid governance can monitor the performance along with periodic audits, and then we can prevent decision risk, which means let's make a knuckleheaded decision just because we read in the Wall Street Journal that this particular corporation is going to increase its dividend by 50%. Oh, let's go out and make this decision, and that decision risk is going to be abandoning our disciplined strategic asset allocation model in favor of tactics that get us. Wait, can you guys see my arms go way out there? All right, so that takes us through what I thought was a super fun reading. I hope you guys got several good nuggets out of this. Probably what we learned mostly in this reading, what I learned mostly in this reading, are the search for the tax efficiency in the context of facing, size, liquidity, horizon, and regulatory needs. So once again, I'm going to go ahead and say to you, look at the behavioral biases here and link those back to the behavioral biases that we talked about in those first two readings. Now, what I want you to do is go to the end of the reading, and there are, I believe, 3 vignettes. They each have 5 or 6 questions in them. And then there's the last vignette that just has 2 questions in it. So I want you to go over those to try to link the importance of the questions in those to these LOSs. And I think you'll find that what I suggested earlier was probably a reflection of reality. So, hey, thanks for watching. I had fun. Good luck studying.